Good morning, madam. My name is Goh Wen-si. Today, we would like to talk about the collapse of Silicon Valley Bank. Here are the list of names of my group member.
My name is Chloe Chong Hui Yi, student ID number 122-130-4590. Now I'm going to discuss a little bit about the company background. In figure 1, this is the logo of Silicon Valley Bank, and in figure 2 you can see that Silicon Valley Bank is actually the one of the subsidiary of SVB Financial Group. And Silicon Valley Bank is located based in Santa Clara in California, USA. It is established in the year of 1983, and before the collapse of SVB, they have a total assets amounting to over $212 billion. SVB focused on luring early stage or startup companies as clients and keeping them as clients as they expanded through the various stages of their life cycles. They also offered financial services to both burgeoning growth and mature enterprises in the technology and life sciences sectors. SVB, Silicon Valley Bank Financial Group, offered banking services to entrepreneurs, innovators, and investors, encompassing nearly half of the US venture-backed technology and life sciences companies, according to its websites. Early-stage startup companies and venture capital-backed businesses make up a large portion of Silicon Valley Bank Financial Group's clientele. Moving to the second part, which is the collapse of Silicon Valley Bank. In figure 3, you can observe the timeline of the key developments, and I will briefly discuss the timeline. So between the year of 2019 and 2021, Silicon Valley Bank Financial Group tripled in size as it benefited from rapid deposit inflows during rapid venture capital and technology sector growth in a period of exceptionally low interest rates. SVB Financial Group invested them primarily in securities with long-term maturities because these deposits are largely uninsured. And in 2022, as interest rates began to rise, Silicon Valley Bank Financial Group saw deposit outflows and a rapid increase in unrealized losses on these securities. And during 10 March of 2023, Silicon Valley Bank collapsed due to these actual and anticipated deposit outflows, which ultimately caused Silicon Valley Bank Financial Group to file for bankruptcy. And Silicon Valley Bank was closed by the California Department of Financial Protection and Innovation, abbreviated as CDFPI. So Silicon Valley Bank actually closed down on the date of 10 March of 2023. Moving to the primary reasons of Silicon Valley Bank's collapse. So there is altogether 4 reasons, as you can see in this slide. So the first one is Silicon Valley Bank's BOD, Board of Directors, and management failed to manage their risk. Second one is supervisors did not fully appreciate the extent of the vulnerabilities as Silicon Valley Bank grew in size and complexity during the inflows of deposits because there is low interest rate. The third primary reasons of the collapse is when supervisors did identify the vulnerabilities, they did not take sufficient steps to ensure that Silicon Valley Bank fixed those problems quickly enough. And the last one, the board's tailoring approach in response to the Economic Growth, Regulatory Relief and Consumer Protection Act, and the shift in the stance of supervisory policy impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. That is from me. Thank you.
Next, I would like to talk about the consequences of collapse on the economy. First, the closure of Silicon Valley Bank caused a big drop in banking sector stock, hurting small and medium-sized banks too. When a bank stock drops, its financial strength is reduced, making it harder for the bank to get out loan. As a result, banks have to tighten their lending standard. This makes it difficult for the bank and people to get loan for investment, operation, and purchase, which slow down the economic activity. Next, Silicon Valley Bank collapse will disturb the financial stability for many startup and tech companies relying on Silicon Valley Bank for working capital. Companies will lose access to deposits which are important for their daily operation like payroll. As a result, the company have to lay off employees and cut salary. Lastly, the collapse of the Silicon Valley Bank has disturbed the financial operation and startup as Silicon Valley Bank are the key economic partner for nearly half of the startup company. Startups have lost their funding for ongoing project and daily operation due to Silicon Valley Bank collapse, leading to downsizes, project postponement, or shutdown. Without financial support, startup could not sustain their research and development effort or bring a new product and services to the market. As a result, it might reduce the innovation and reduce the customer spending and choice, and indirectly slow the economy expansion.
I proceed with 4.0 impact of the company's collapse on the economy and other firms worldwide. So here for impact, okay, first thing first, mention market instability. Immediate market impact. SVP bankruptcy caused significant shock in financial markets, such as Japanese, South Korean, and Hong Kong stock markets dropped by 2.67, 3.91%, 2.81% respectively. The European banking index fell by 7%, raising 120 billion euros from the market. Systematic risk highlighted the potential for smaller institutions to generate systematic issues, increased monitoring, and possible conflict on institution with similar backgrounds. It was highlighted that supervisory lessons should be applied to a larger range of institutions. So next, impact on technology sector firms, disruption to tech enterprise. SVP closed ties to the technology sector mean it collapsed, significantly impacted startup and technology companies. The sudden loss of a key financial partner disrupted operation, delaying innovation and growth. Financial constraint, tighter liquidity, and higher borrowing costs for tech companies affected operational capacities and growth trajectories. Role of specialized banks underline the crucial role that banks like SVP play in supporting fast-growing sector. Okay, next, change in regulatory. After the collapse of SVB, regulatory authorities performed exhaustive review to reflect and make necessary changes. The Federal Reserve report noted opportunities for improvement in supervisory measures. For example, supervisor mistake, supervisor underestimate the depth of SVB vulnerabilities, need for a more thorough and proactive regulatory approach. Areas to improve risk identification, building resilience in the banking system, changes supervisor behavior and improving system. And the goal prevent future collapse is establish a strong banking system capable of withstanding various financial strain. Okay, last but not least, impact on economy sector. The collapse of SVB had profound and significant economic consequences, especially for the technology sector, which was heavily dependent on its services. Cash flow concerns, startup and IT company face immediate cash flow problem due to relying on SVB for loans and financial services. Delays in product development. Financial instability led to delays in product development and project timelines. Loss of skilled labor. Skilled workers left affected companies, often moving to more stable industries or regions, further reducing innovation. Higher borrowing rates. Companies were forced to seek alternative funding sources at higher borrowing rates, increasing financial strain. Loss of investor trust. Investor confidence was shaken, resulting in a slowdown in startup funding and greater caution among investors. Long-term changes in investment strategy. Investors shift strategies favoring established companies over risky startup, potentially slowing technological advancement. That's all from me. Thank you.
Hi, my name is Tam Kishan. Now I'm going to discuss about the type of risk associated with Silicon Valley Bank's collapse. So what is business risk? Basically, business risk is a component that has the potential to lower profitability or even collapse a company. First, let's examine liquidity risk. Liquidity risk arises when a business cannot convert its assets to cash without suffering significant losses. For SVB, the risk became critical due to several factors. First, SVB lacks contingency liquidity planning. This lack of foresight means they were unprepared for large-scale withdrawals. As interest rose, startups reduced large deposits to cover their costs, forcing SVB to liquidate 21 billion worth of securities. This action led to a substantial after-tax loss of 1.8 billion. The bank heavily relied on uninsured deposits, particularly from the IT sector, which is highly sensitive to interest rate change. When SVB announced plan to sell 2.2 billion in shares to strengthen its balance sheet, it triggered to a classic bank run. Fearing bankruptcy, investors withdrew as much as 40 billion in a single day. Next, we will discuss market risk. specifically interest rate risk. This is the risk of loss due to the fluctuation in interest rate, which can significantly impact the value of fixed income securities. In 2020, the Federal Reserve aggressive rate hike devalued SVB's bond portfolio. Despite the risk-free perception of long-term government bonds, rising interest rates heavily impact this investment. SVB neglected interest rate hedging, prioritizing short-term profit over long-term stability. Also, there was a mismatch between SVB's short-term liabilities and long-term assets, exacerbating their vulnerability to interest rate shock. Despite this issue, SVB still maintained a high liquidity rating, indicating a serious underestimation of risk involved. Next is operational risk. Operational risk refer to the losses arising from the failure in personnel, system, or internal procedures. SVB operational risk factor included significant management and oversight shortcomings. In 2020, SVB experienced a leadership vacuum for about 8 months, leaving the risk management team and board possibly unaware of emerging portfolio risks. And also, the risk committee's board had limited expertise in risk management, with only one of 7 members having relevant experience and none had served as a chief risk officer. Slow go in governance control also future exposing SVB to operational risk. Lastly, we consider strategy risk, which involve risk from poor business decision, planning, or strategy implementation. Post-pandemic, SVB shifted its focus to securities investment, increasing its exposure to interest rate risk. The bank concentration on the tech industry and reliance on uninsured deposits make it particularly susceptible to sector-specific shock. The EGRRCPA lowers some regulatory standards, resulting in less supervision strictness for SVB. This regulatory rely enable SVB to operate with less capital and liquidity constraints, which contribute to strategy misstep.
Now I would like to continue to talk about the recommendation of risk management strategy. Firstly, Silicon Valley Bank could set a specific minimum capital and liquidity requirement. Silicon Valley Bank, classified as a lower risk, has insufficient capital to handle financial stress. Therefore, tighter requirements will help the bank to withstand crises and keep sufficient reserve for unexpected economic shock. Furthermore, Silicon Valley Bank could conduct a stress test to stimulate different economic situations and find the potential weaknesses. This is because better overseen and stricter stress tests will help the Silicon Valley Bank to identify risks earlier. By implementing the stress test, regulatory can ensure that the bank are better prepared for unfavorable economic situations, therefore reducing the likelihood of failure.
Next, it is critical to strengthen SVB's governance and risk management practice. SVB should establish a risk management committees within the board of directors. Integrating risk management into the organizational culture ensure all employees and board members understand and manage risk in their roles. Developing a strong risk framework can properly reflect changes in the business and regulatory environment. SVB must implement a comprehensive risk assessment process and maintain detailed record of potential risks. SVB should conduct regular internal and external audits to evaluate risk management practice effectiveness and take prompt action to address issues. In addition, SVB is also able to utilize advanced technology and risk analytics, which can provide real-time insight for informed decision making. Lastly, I will recommend SVB to diversify its deposit base. SVB can reduce its reliance on a single industry and enhance its resilience to shock by diversifying its deposit base. By attracting deposits from healthcare, manufacturing, and financial sector, which are all less sensitive to market changes than the IT industry. SVB can attract a wider range of clients and funding sources. SVB can also achieve their diversification by developing personalized financial goods and services, which, when combined with the targeted marketing and relationship building tactics, can improve financial stability and liquidity, and also lowering SVB's vulnerability to the volatile tech industry. That's all from me. Thank you.
Analysts, Conclusion: the collapse of SBB highlight how important it is for banks to have strong risk management and regulatory observation because of the major disruption and financial instability caused by SBB dependent on technology. It is imperative that deposit portfolio be diverse, stress testing be required, and capital and liquidity standard be strictly enforced. This incident also highlighted how important it is to have a strong framework for risk management that includes regular audits and sophisticated analytics. Because of the interconnection of today's economies, the global fallout from SBB failure highlights the need for cooperation between regulators and financial institutions in order to create a robust banking system that can withstand a variety of financial stresses and guarantee long-term stability. That's all for us. Thank you.